They froze every bank account in the country. Overnight. Buenos Aires, December 1, 2001. You wake up and go to your bank. The door is open. The staff are at their desks. Everything looks normal. You try to withdraw money. The teller apologizes. There is a limit. 250 pesos per week. That's it. Your savings, everything you have worked for, is sitting in an account you can see on paper but cannot touch. The government called it El Corralito. The little corral. A fence around your money. Announced on a Friday. Effective immediately. No vote. No warning. No transition period. One signature from the economy minister, and the savings of 37 million people were frozen in place. It lasted 14 months. This is not a story about Argentina's unique dysfunction. Argentina had been to the IMF 30 times by 2001. It had a history of instability that the rest of the world used to reassure itself that this could never happen to a stable country, a serious country, a country with real institutions. That reassurance is precisely what makes the forensic record so important. Because the mechanism that destroyed Argentina's middle class in 2001 does not require a dysfunctional country. It requires specific conditions. And those conditions are not unique to Argentina. Let's open the autopsy. To understand December 2001, you have to understand 1991. Argentina had spent the 1980s in monetary chaos. Inflation that reached 3,000% in 1989. A currency, the austral, that was collapsing so fast that prices changed between the morning and afternoon. Savings destroyed. The middle class evaporated. The experience was so traumatic that when Economy Minister Domingo Cavallo proposed a radical solution in 1991, the country accepted it without hesitation. The solution was the Convertibility Plan. 1 Argentine peso, pegged to $1. Fixed. By law. The central bank was required to hold dollar reserves equal to every peso in circulation. The peso was, in legal terms, a dollar. Argentines could hold pesos or dollars interchangeably. Banks held both. The peg was the anchor. It worked. Inflation collapsed from 3,000% to single digits within 2 years. Foreign investment poured in. The economy grew. The middle class rebuilt. Argentines who had been burned by the austral destruction now saved in pesos with confidence because pesos were dollars. The convertibility plan became a source of national pride. Cavallo was celebrated as the man who fixed Argentina. For 9 years, the anchor held. Then came the pressures. Brazil, Argentina's largest trading partner, devalued its currency in 1999. Suddenly Brazilian goods were dramatically cheaper than Argentine goods. Argentine exports lost competitiveness overnight. The economy contracted. Unemployment rose. Tax revenues fell. The government borrowed to cover the gap. It borrowed in dollars, because that is what international creditors demanded, and because pesos were dollars anyway. But here is the mechanism that made the borrowing fatal. Argentina was collecting taxes in pesos, which were pegged to dollars, but the economy was contracting. To maintain the peg, the central bank had to hold dollar reserves equal to every peso in circulation. As the economy weakened and the government borrowed more dollars, the debt grew in dollar terms. The revenues to service it were in pesos that depended on a peg that required dollar reserves. The country was depleting to make debt payments. It was a trap with no exit that didn't involve pain. Devaluing the peso would break the law, destroy savings held in pesos, and trigger a banking crisis because banks had dollar-denominated loans to Argentine borrowers who earned pesos. Maintaining the peg required austerity that deepened the recession and further reduced revenues. Borrowing more extended the timeline but increased the debt load. The IMF provided a $48 billion rescue package in 2000. The largest bailout in IMF history at that point. The conditions required fiscal austerity, spending cuts, public sector wage reductions. The austerity deepened the recession. Unemployment reached 22%. The economy contracted for the fourth consecutive year. By November 2001 the bank run had begun. Argentines who understood what was happening were quietly converting pesos to dollars and moving dollars out of the country. $3 billion left the banking system in November alone. The government watched its dollar reserves draining and understood that the peg could not survive if the run continued. Every dollar that left was a dollar that could not back the pesos that remained. Economy Minister Cavallo, the same man who had designed the successful peg in 1991, announced El Corralito on December 1. The logic was defensive. Stop the bank run. Prevent the reserve drain. Buy time. The peg could survive if the dollars stopped leaving. The logic was correct in the short term and catastrophic in the medium term. Yes, freezing the account stopped the bank run. It also told every Argentine that their savings were not safe in the banking system. The Corralito was supposed to be temporary. It immediately became proof that the government would impound private savings when it needed to. Trust, which had taken a decade to rebuild after the 1980s, collapsed in a weekend. What followed is documented in detail. December 19 and 20, 2001. Spontaneous protests erupted across Buenos Aires. The cacerolazos, the pot-banging protests, filled the streets. Supermarkets were looted. The government declared a state of siege. The protests intensified. President de la Rua resigned and fled the Casa Rosada by helicopter on December 20. 5 presidents in 11 days followed. Argentina defaulted on $100 billion in sovereign debt, the largest sovereign default in history at that time. The peso was devalued. The peg was abandoned. 1 peso, which had legally been $1, was forcibly converted to 3 pesos per dollar overnight. Here is the forensic breakdown of what that meant for individual Argentines. A person who had 100,000 pesos in a bank account on December 1 had, in legal terms, $100,000. That was the peg. That was the law. On January 7, 2002, the peg was abolished. 100,000 pesos now equaled $33,000. The government did not compensate the difference. The person lost 67% of the dollar value of their savings by government decree. Not by market forces. Not by inflation accumulating over years. By a single legal decision applied overnight to every peso-denominated account in the country. Dollar-denominated accounts were converted to pesos at the old 1-to-1 rate and then immediately subjected to the new 3-to-1 devaluation. A person who had held their savings in dollars inside an Argentine bank account, specifically to avoid exactly this kind of peso risk, discovered that the government had converted their dollars to pesos at 1-to-1 and then devalued those pesos to 33 cents on the dollar. The legal structure that had guaranteed the dollar value of their savings was retroactively voided. The process was called pesificación. The forcible conversion of dollar assets to pesos. It applied to bank deposits, to mortgages, to corporate contracts. Anything denominated in dollars inside the Argentine financial system was converted to pesos at rates set by the government. The people who had played by the rules, who had trusted the legal architecture that the government itself had constructed, absorbed the loss. The government's fiscal problem was transferred to private balance sheets through a mechanism that required no legislation beyond the emergency decree. The middle-class outcomes are documented specifically. Professionals, engineers, lawyers, teachers, accountants who had spent the 1990s rebuilding savings destroyed in the 1980s watched those savings cut by 67% in purchasing power in a single month. Small business owners whose costs were in dollars but whose revenues were suddenly in devalued pesos faced immediate insolvency. The poverty rate, which had been around 25% before the crisis, rose to over 50% within 18 months. The formal middle class contracted more severely than at any point in Argentine history. The people who survived with their wealth intact fall into a documented and narrow category. Those who had moved savings outside the Argentine financial system before December 1st. Dollars held in Uruguayan bank accounts, in Miami real estate, in cash outside the banking system, were not subject to pesification. They were not frozen by El Corralito. They retained their dollar value through the devaluation. The mechanism that destroyed savings was specifically the mechanism of holding assets inside the formal financial system of the country whose government was under fiscal stress. Assets outside that system were untouched. Those who held physical gold. Gold held in private hands, outside the banking system, could not be pesified. It could not be frozen. Its dollar value increased in peso terms as the devaluation proceeded. An ounce of gold worth $310 in 2001 translated to approximately 930 pesos at the new exchange rate. The physical metal holder's peso purchasing power tripled as the currency collapsed. Those who held hard assets with income generation independent of the peso system. Agricultural land producing export crops received dollar revenues. The devaluation actually improved their position. The farmers and landowners who exported commodities in dollars while their costs were in devaluing pesos experienced the devaluation as a boost to profitability. The documented losers are equally specific. Everyone who trusted the formal financial system. Every person who held pesos in a bank account because the government told them pesos were as good as dollars. Every person who held dollars in an Argentine bank account because the government guaranteed convertibility. Every person who held government bonds because the government promised repayment. Every form of trust placed in the formal financial system of a government under acute fiscal stress was rewarded with loss. The lesson the forensic record delivers is not that Argentina is uniquely corrupt. Every government that has faced the choice between fiscal pain and confiscating private savings through currency mechanisms has faced the same set of options. The sequence is consistent. Borrowing to defer pain. Austerity that fails to close the gap. Emergency measures that freeze access to savings. Devaluation that transfers the government's problem to private balance sheets. Default that eliminates the obligation to foreign creditors while domestic savers absorb the loss through the currency. The convertibility law that guaranteed 1 peso equaled $1 was a law. Laws are changed by governments under pressure. The bank accounts that held those guaranteed pesos were inside the financial system of the government under pressure. When the crisis became acute enough, the government's need to survive politically outweighed every legal guarantee it had made to private savers. This is not cynicism. It is the documented record of Argentina 2001, of Lebanon 2019, of Cyprus 2013, of every case where a government under fiscal stress has had access to private savings through the formal financial system. The pattern is not a conspiracy. It is an institutional response to fiscal pressure that follows the same sequence because the incentive structure of governments under stress is consistent across countries and across time. What the Argentine forensic record adds to this channel's documented cases is one specific detail that most analysis misses. The convertibility plan worked for a decade. The peg was credible for 9 years. The savings that were destroyed in 2001 were savings that had been rebuilt specifically because the system had worked. The Argentines who trusted pesos in 2001 were not naive. They were rational actors responding to 9 years of demonstrated stability. Their trust was not misplaced based on the evidence available to them. It became misplaced when the conditions that had sustained the system changed faster than they could respond. That is what makes the pattern dangerous. It is not visible when it is building. It is only fully visible after it has resolved. The signals existed. The debt trajectory was public. The reserve drain was documented in monthly central bank reports. The bank run data for November 2001 was visible in real time to anyone watching the numbers. But the signals existed inside a system that had been stable long enough that stability felt permanent. 9 years of a working peg had conditioned every rational actor to expect the peg to continue working. The people who responded to the signals early, who moved savings outside the Argentine financial system in 2000 or early 2001, were not smarter than the people who stayed. They were earlier. They had updated their model of the system before the majority did. The middle class that disappeared in December 2001 had rebuilt itself from nothing after the 1989 hyperinflation. It had trusted the new system because the new system had worked. It had placed its savings in the institutions the new system endorsed. It had done everything right by every rule the new system had established. And when that system failed, the savings that had been placed in trust were not protected. They were the mechanism through which the system's failure was distributed to the people who had trusted it most. Not because the government was malicious. Because the government was desperate. And desperate governments reach for what is reachable. Private savings inside the formal financial system are always reachable. That is the forensic record. That is the pattern. And it has appeared in every country where the fiscal pressure became acute enough and the savings were accessible enough. Argentina in 2001. Lebanon in 2019. Cyprus in 2013. The geography changes. The mechanism does not. If this forensic breakdown gave you a new lens, subscribe to Independent Financial Historian. This channel examines the documented record of what governments actually do when the pressure becomes acute, so you can read the situation before it reads you. Drop a hammer and anvil in the comments if you are already building the protocol. Tell me what you want me to dig into next. I read every single one. And remember what every Argentine who lost savings in December 2001 understood too late. The guarantee was real until the guarantor needed the money more than you did.